Hello and welcome to my presentation. My name is Mahan Tahvildari. I'm a PhD student in finance at the UCAM Catholic University of Murcia in Spain, and the title of this presentation is Quantitative Performance Analysis of German robo-advisors during the COVID-19 crisis. We start with an introduction, define what the subject of study is, the motivation, then continue with the methodology and the databases, and present and discuss the results. Let us begin with the introduction. What are robo-advisors? There is no unified definition of a robo-advisor. However, we can describe what a robo-advisor does. Basically, there are automated online services providing financial advice and managing customers' investment portfolios with the use of algorithms. Robo-advisors are part of financial technology, fintech, and like any other fintech service, they emerged through digital transformation. In the case of robo-advisor, the digital transformation happened in wealth management. So robo-advisors are the new trend to get personalized investment advisory that aim to replace traditional advisory. The process of a robo-advisor begins with the definition of the investment universe, the selection of the asset classes. Typically, robo-advisors use exchange-traded funds, ETFs, on indices like stock and bond indices to construct portfolios, because ETFs are low-cost instruments and with them they can better reflect the markets based on their strategies. The next feature is the asset allocation model. For example, if a robo-advisor applies a mean variance framework, then the means and variances of the asset class returns and correlation between them are estimated within the algorithm. The last step is the portfolio construction. This is actually the process step that investor sees because he or she fills in a questionnaire for collecting the information about return and risk preferences. This is done by a profiling algorithm. And based on this, the robo-advisor recommends a portfolio, and then the investment process begins. The robo-advisor monitors the portfolio and does rebalancing trades based on changing market conditions or changing risk preferences of the investor. There are several asset allocation methods applied by robo-advisors. Most of them are based on modern portfolio theory, like the mean variance optimization, but there are also other methods like the Black-Litterman model or factor investing, also called smart beta, conditional value at risk, scenario optimizations, or other strategies based on technical analysis like the mean reversion trading. The subject of study is the performances of German robo-advisors during the financial crisis caused by the COVID-19 pandemic in the period between the last day of December 2019 and the first day of February of this year. For this reason, we have collected 44 portfolios data from 7 German robo-advisors, calculated risk-adjusted performances, and compared them to appropriate benchmarks. In addition, we have collected other important key figures like investment strategies, asset allocation methods, fees, and assets under management by studying the white papers and other regulatory documents that are provided by the robo-advisory companies. A little background. The first robo-advisors started shortly after the financial crisis in 2008 in the US. The first companies were Betterment and Wealthfront that provided robo-advisory services in 2010 and 2011. Then the market expanded to other regions like Europe and Asia. The global assets under management of robo-advisors are estimated to be 1.5 billion US dollars in 2021. And they are expected to grow at an annual rate of 20% for the next 4 years. which is which shows how big the market's potential is. The focus of this study is on robo-advisory services from Germany for basically three reasons. Firstly, the data availability is sufficiently good for empirical analysis. So we have data, information about asset allocations, about price development, and so on. Secondly, Germany is a large market in Europe, a large robo-advisory market. The assets under management are 15 billion euros, and it's one of the largest and fastest growing submarkets. Moreover, the disruptive potential of the robo-advisory market in Germany is really high, and only little research exists to understand the methodology and performances of robo-advisory, especially during downturn phases. We continue with the methodology of this research. These are the selected robo-advisors analyzed so far. We have Quirion, Genmon, Quantifarm, Fintego, Grouni, TrueVest, and Easyfolio with the number of portfolios. The start dates give the start dates of the time series of the historical prices of the portfolios. Moreover, we have collected information about 5 other German robo-advisors, like white papers containing information about asset allocation strategies, fees, and so on. And the aim is to extend the databases to have a more comprehensive study for the paper to be published. And for disclosure, I'm not working for any of these robo-advisory companies, nor do I receive a compensation for the study. The analysis serves only scientific purposes. The first step is to analyze the portfolio's holdings, the constituents, to determine the ratio of equities to bonds, with the aim to match the portfolios to appropriate benchmarks. The analysis of the robo-advisors has shown that they are mainly created through ETFs, as mentioned before, that invest in equities and bonds. So based on this information, I have created 10 asset allocation classes called peer groups. And for each peer group, I have a benchmark. So we have, this is the second step, the benchmark construction, 10 different benchmarks, benchmark 10, 20, 30, up to benchmark 100. And the last number represents the equity share. So for example, if you take benchmark 40, then the stock to bond ratio is 40-60, meaning that 40% of the benchmark contain equities and 60% bonds. For the creation of the benchmark, we need also indices or ETFs. The bond component is the Bloomberg Barclays Global Aggregate Bond Index. It is composed of government and corporate bonds, as well as asset-backed securities from countries all over the world. The cost is assumed to be 0.2% per year. And for the equity component, we choose the Global Equity Index MSCI All Countries World Index, which consists of stocks from developed and emerging markets. Actually, it contains the MSCI World and the MSCI Emerging Markets Index. The cost is assumed to be 0.47% per year. This slide depicts the benchmark stability, which is very important because over time the weights of the two components of the benchmarks can vary. For example, in a time interval where shares outperform bonds, the asset allocation changes. In these cases, we have applied a rebalancing method with a tolerance of 3%, and it is carried out to, for example, sell shares from the better performing component and buy shares from the complementary index to rebalance it and to restore the initial weighting. For example, if you take the benchmark 50, we have initial weighting of 50% stocks, 50% bonds, and when it changes to 53% stocks and 47% of bonds, then the rebalancing trades will change it back to the initial weighting. These rebalancing trades incur costs that are considered in our analysis. In the 7-year period from 2014 until the March of this year, only 1 to 6 rebalancing events occurred, depending on the benchmark. Accordingly, the rebalancing is carried out on average once a year in the 7-year period, and this represents a good compromise between an accurate benchmark and a passive investment. The considered robo-advisors also carry out rebalancing, mostly dynamically with a tolerance and an annual frequency. All measures are calculated on a monthly basis using logarithmic monthly returns. We use a modified version of the Sharpe ratio as a symmetric risk-adjusted performance that is defined by the quotient of the mean of the return of the asset and a standard deviation of the returns in the case that the returns are non-negative. When the returns are negative, we use the product of them because this ensures that the Sharpe ratio is comparable in any case, especially for negative returns. As an asymmetric risk-adjusted performance, we use the risk-return ratio, which is calculated by the maximum drawdown and the cumulative return. It's the quotient of the cumulative return and the maximum drawdown. And again, here we use the modified version. So we have the quotient if the cumulative return is positive or 0. And if the cumulative return over the entire period is negative, then the risk-return ratio is calculated as the product of the two measures. And again, this ensures the comparability. Another measure we calculate is the recovery time. The recovery time since the low point of the COVID-19 market crash, it's calculated by the time when the price of the portfolio reaches its last high before the COVID-19 market crash. What are the results? The hypothesis is the selected German robo-advisors could not outperform their benchmarks during the COVID-19 crisis. And the results, they verify the hypothesis because only 2 of the 44 portfolios analyzed were able to beat their benchmarks in terms of the Sharpe ratio as a symmetric risk-adjusted performance. In almost all peer groups, the robo-advisor portfolios performed worse. The better performing portfolios are in the peer groups with benchmark 10 and 100, where the equity share is 10% and 100% respectively, and no rebalancing was necessary for the benchmarks during the period under review for benchmark 10 and benchmark 100. Actually, for benchmark 100, there is no rebalancing because it contains only one component, the equity component. In the benchmark 10 group, Fintego's portfolio performed best, and in the benchmark 100 group, it was Quirion. Considering asymmetric risk-adjusted performance, the risk-return ratio, 3 robo-advisors, the robo-advisors Fintego, Moneyfarm, and Quirion were able to reduce the drawdown risk in some of the peer groups, performing slightly better than their benchmark in terms of the risk-return ratio. The recovery time indicates that almost all robo-advisors, except for Moneyfarm and peer group benchmark 70, took longer to reach their pre-downturn level after their low during the COVID-19 crisis. The robo-advisors, they suffered significantly fewer losses during the market downturn, meaning that they were able to reduce the risk for the investor at the expense of return. Not surprisingly, higher fee robo-advisors like TrueVest, which apply a fee of 4.5% per annum, tend to underperform. Most of the portfolios of Ginman and TrueVest could not show any gains. They performed worst. The robo-advisor portfolios with the largest losses reduced their equity exposure too late during the crash and sold near the bottom, so that the realized losses could not be recovered after the market recovered. The underperformance of the robo-advisors can be explained by the fact that trading strategies of the robo-advisory they lowered the risk during the downturn phase. So they reduced equity exposure, they sold their equity shares, but they increased the equity exposure too late after the downturn and by rebalancing, and thus they do not benefit from the recovery as the benchmark did. What's the conclusion? The selected German robo-advisors could not outperform their benchmarks during the COVID-19 crisis. However, a few robo-advisors were able to reduce the drawdown risks by reducing the equity exposure during the downturn phase. Because the stock market recovered relatively fast, they were not able to profit optimally from the recovery, because the robo-advisors have more defense investment strategies during the market crash. And these results suggest that the asset allocation strategies of the robo-advisors have weaknesses in times of crisis and a still need for improvement, especially when the market dynamic is high. What is the work in progress? First of all, the expansion of the databases by adding more portfolios of other robo-advisors. Secondly, performing a long-term analysis from 2014 and the investigation of individual periods such as calendar years or other downturn phases like 2015 and 18. The calculation of Jensen's alpha and beta through the capital asset pricing model over the extended term by performing regression analysis. Applying a returns-based style analysis from Sharpe to replicate the portfolio's exposures over time to typical asset classes. And the last point is a correlation analysis to determine the degree to which individual strategies or other variables have an impact on the performance. This was my presentation about my current research status about the performance of German robo-advisors. The plan is to have a more comprehensive study by the end of the year to be published next year. Thank you very much for your interest in my research. Have a nice day.